There's a very specific feeling that hits you in the pit of your stomach when you watch a fortune evaporate in real time. It is not pain, exactly. It is colder than pain. It is a mixture of regret, confusion, and a sudden, paralyzing fear that you have made a terrible mistake. If you were watching the markets over the last 48 hours, you know this feeling intimately. You watched gold and silver rip higher, looking like they were finally ready to break the sound barrier, and then, without warning, you watched them snap back. You saw the red candles erase days of progress in hours. You saw the headlines shift from euphoria to panic. And right now, as you sit here on this Saturday morning, January 31st, 2026, you are asking yourself the question that destroys portfolios more than any other. Is it over? Was I wrong? Is this the top? I am here to tell you that this reaction, this biological urge to flee, to sell, to stop the bleeding, is exactly what the market is designed to trigger. It is a mechanism, a machine built to separate the impatient from their capital. What you witnessed this week was not a fundamental shift in the value of precious metals. It was not a sudden solution to the global debt crisis. It was not a magical discovery of 1 billion ounces of silver in a warehouse. It was a magic trick, a sleight of hand performed by the calendar, the futures exchange, and the mechanics of a leveraged market. And if you fall for it, if you sell your position now because you are scared of a shadow, you will look back on this weekend as the moment you handed your wealth over to the people who understand the game better than you do. We need to deconstruct this sell-off with the precision of a forensic scientist because the narrative you are being fed is wrong. The narrative says that the market is rejecting higher prices. The narrative says that the rally was a bubble. But the data says something entirely different. The data says that this was a mechanical event, a necessary flushing of the pipes that happens when the calendar flips and the contracts roll. To understand this, we have to peel back the layers of the financial onion and look at the dirty, complex plumbing of the futures market, because that is where the price is set, not in the coin shop, not in the jewelry store, but in the digital trenches of the exchange. Let's talk about the concept of the front month. In the world of futures trading, contracts have an expiration date. They are not like stocks that you can hold forever. They are time bombs. When the calendar approaches the delivery period for the active month, traders are faced with a binary choice. They can either stand for delivery, meaning they have to come up with the full cash value of the contract and accept physical bars of metal, or they can roll their position. Rolling means selling the contract that is about to expire and buying a contract for a future month. It sounds simple, but when you have thousands of traders, billions of dollars, and massive leverage all trying to fit through this tiny door at the same time, it creates a stampede. Imagine a stadium filled with 10,000 people. Suddenly, an announcement comes over the loudspeaker that everyone must leave through Gate A in the next 10 minutes, or they will be locked in. What happens? Panic, chaos. People are trampled. The price of getting out the door skyrockets, and the price of staying in crashes. This is what happened this week. The longs, the speculators betting on the price going up, who didn't want to take delivery of physical metal, were forced to sell their front-month contracts. This wave of forced selling hits the market like a tsunami. It is not driven by a belief that silver is worth less. It is driven by the logistical necessity of exiting the contract before the delivery notice is issued. When you see a vertical red line on the chart during a delivery week, you are not seeing price discovery. You are seeing a traffic jam. You are seeing the mechanical unwinding of leverage. And once that traffic jam clears, once the weak hands have rolled or folded, the pressure evaporates, the stadium is empty, the gate is open, and the organic buyers, the ones who actually want the metal, the ones who are playing the long game, step back in and pick up the pieces at a discount. This is why sell-offs during delivery periods are often the most misleading signals in finance. They look like crashes, but they are actually transfers. Transfers of inventory from the weak, leveraged speculators to the strong, capitalized accumulators. But to truly understand why this shakeout is a gift and not a curse, we have to look at the psychology of the tourist investor versus the local. In every bull market, there are two types of participants. The local has been here for years. They know the neighborhood. They know that sometimes the street lights go out. They know that sometimes the bus is late. They are not rattled by the daily noise because they understand the structural reality of the place. The tourist, on the other hand, is just visiting. They saw a brochure that said, "Gold is going to the moon." They bought a ticket because they wanted a quick thrill. They have no conviction. They have no understanding of history. When the market spikes, the tourist feels like a genius. They text their friends, they post on social media, they count their paper profits, and start mentally spending the money. This is the momentum phase. It attracts the crowd, but the crowd is fickle. The moment the price stops going up, the moment that red candle appears, the tourist panics. They don't ask, "Why is it down?" They just scream, "Get me out." This creates a cascading effect. One tourist sells, which pushes the price down, which scares the next tourist who also sells. It becomes a self-fulfilling prophecy of fear. This week, we saw the tourists get slaughtered. They chased the price at the top, used too much leverage, and got washed out when the mechanical selling started. And I want to be very clear, this is healthy. It feels terrible, but it is necessary. A market cannot go up in a straight line forever. If it did, it would become a fragile bubble that pops and leaves nothing behind. A healthy bull market needs to stop, shake off the parasites, rebuild its energy, and then climb higher. The sell-off you are seeing is the market exhaling. It is the market cleaning house. Now let's zoom out. Let's look at the history that the tourists ignore. If you study the gold market of the 1990s, you see a period that was known as the boring box. For years, the price of gold bounced between a floor and a ceiling. It was dead money. Investors who bought the bottom of the box and sold the top made fortunes. But investors who bought the breakout expecting a moonshot got crushed over and over again. Then, in the late 90s, the floor broke. Gold fell into a bear market that lasted for years. The people who held on through that period were mocked. They were called dinosaurs. They were told that gold was a barbarous relic. But those who understood the fundamental truth that fiat currencies are mathematically designed to lose value held on. They endured the pain. They endured the boredom. And what happened next? The 2000s bull market. Gold went from $250 to $1,900. The people who sold during the boring box or the bear trap missed one of the greatest wealth transfers in history. The lesson here is that the market can be wrong for a long time. The price can disconnect from value for years. But eventually gravity takes over. Eventually the debt matters. Eventually the printing press matters. We saw a similar pattern in 2011. Silver hit $50. Euphoria was everywhere. Then the margins were raised, the paper market was flooded with shorts, and the price collapsed. It spent the next few years grinding lower. It was a brutal, demoralizing period. Many people sold at the bottom, swearing they would never touch precious metals again. They looked at the chart and saw a failure, but the smart money looked at the chart and saw an opportunity. They saw that the fundamentals hadn't changed, only the sentiment had. They used that decade of low prices to accumulate massive positions. Fast forward to today, January 2026. We are in the early stages of the next great leg up. The fundamentals are stronger than they were in 2011. The debt is exponentially higher. The geopolitical instability is worse. The industrial demand for silver is breaking records. And yet when the price drops for 2 days, people panic. They forget the lessons of history. They let the short-term noise drown out the long-term signal. Do not be the person who sells in 2026 only to watch the price triple in 2027. Do not let the volatility of a delivery week scare you out of a position that is designed to protect you from the collapse of the currency. We must also confront the paper versus physical dichotomy, because this is where the real deception lies. When you look at the spot price of silver on your screen, you are looking at the price of a digital contract that claims to represent silver. You are not looking at the price of the metal itself. This is a crucial distinction. The paper market is leveraged hundreds of times over. For every ounce of physical silver in the COMEX vaults, there are hundreds of paper ounces traded. This means that the paper price is determined by the flow of speculative capital, not by the supply and demand of the physical metal. While the paper price was crashing this week, what was happening in the real world? Were the solar panel manufacturers selling their silver? No. Were the electronics companies dumping their inventory? No. Were the strategic stockpiles of nations being liquidated? Absolutely not. The physical market is tight. The premiums are holding. The delivery times are stretching. The industrial users, the entities that actually need the metal to function, are not selling. They are buying. They are using these dips to secure more inventory at a cheaper price. This disconnect creates a massive opportunity for the individual investor. When the paper market throws a tantrum and drives the price down, it is effectively putting the physical metal on sale. It is a subsidy from the speculators to the accumulators. The speculators are subsidizing your stack. They are panicking so that you can buy cheaper. Instead of being afraid of the red candles, you should be thanking them. You should be looking at this sell-off as a Black Friday sale for the only asset class that has no counterparty risk. But there is another layer to this sell-off that we need to address: the geopolitical and macroeconomic theater. We just watched the U.S. government flirt with a shutdown. Again, it was all over the news. Will the government close? Will the checks stop? And at the last minute, like a poorly written drama, they reached a deal, a stopgap measure, a patch. The markets rallied on the news. The dollar bounced. Crisis averted, they said. This is the ultimate distraction. The crisis was not averted. The crisis was delayed. And in the process of delaying it, they guaranteed that the underlying problem, the debt, would get worse. Every time they kick the can down the road, the can gets heavier. The relief rally in the dollar that pressured gold and silver this week is a mirage. It is based on the idea that the U.S. government is functional because it managed to keep the lights on for another few months. But a functional government does not run a deficit of $2 trillion a year during peacetime. A functional government does not pay more in interest on its debt than it pays for its military. The market reacted to the headline, shutdown avoided, but ignored the trend, debt exploding. This is typical. Markets are short-sighted. They trade the news of the day. But you are not a day trader. You are a wealth preserver. You have to look past the headline. You have to look at the math. And the math says that the only way out of this debt spiral is to inflate the currency, to print the difference, to debase the dollar. That trajectory has not changed one iota because of a budget deal in Washington. In fact, the deal confirms it. It confirms that there is no political will to cut spending. There is no political will to balance the budget. There is only the will to print. And when they print, the value of the denominator, the dollar, falls, and the value of the numerator, gold and silver, rises. It is simple math. No amount of short-term volatility, no amount of futures market manipulation, no amount of technical selling can change that equation. Gravity always wins. The sell-off you are seeing is the market fighting gravity. It can fight for a day, a week, maybe a month. but eventually it will tire. And when it does, the rebound will be violent. Let's talk about silver specifically, because silver is the metal that breaks hearts. It is the bipolar metal, half money, half industrial commodity, and fully manic depressive. When gold moves 1%, silver moves 3%. When gold sneezes, silver catches pneumonia. This week, silver took a beating. It fell harder and faster than gold, and this has caused a lot of people to question the silver squeeze thesis. They ask, if silver is so scarce, why is the price dropping? The answer lies in the size of the market. The silver market is tiny. It is a rounding error compared to the bond market or the stock market. This means that it takes very little capital to move the price. A single large hedge fund can smash the price of silver with a few large sell orders. But this small size is also its greatest strength. When the sentiment turns, when the money tries to flow back in, it is like trying to push the ocean through a garden hose. The pressure builds instantly. The price explodes. The industrial demand for silver is the silent whale in the room. We talk about investment demand, but investment demand is fickle. Industrial demand is relentless. Solar panels need silver. EVs need silver. AI servers need silver. 5G towers need silver. This demand is not price sensitive in the short term. A factory cannot stop production just because silver went up $10. They have contracts to fill. They have quotas to meet. They will pay the price. We are entering a period where the above-ground stocks of silver, the stockpiles that have been built up over decades, are being drawn down. We are running a structural deficit. We are consuming more silver than we are mining. This has been happening for years. Eventually, the stockpiles run out. Eventually, the buffer is gone. And when that happens, the price discovery mechanism shifts from the paper market to the physical market. The price will no longer be set by how many paper contracts are sold on the COMEX, but by how much a user is willing to pay to get actual metal in their hand. That day is coming. The sell-off this week is a distraction from that inevitability. It is noise. It is sound and fury signifying nothing. Do not let it shake you out. I want to pose a question to you. Are you an investor or are you a gambler? A gambler looks at the chart every 5 minutes. A gambler gets a dopamine hit when the line is green and a cortisol spike when the line is red. A gambler is trying to beat the casino. An investor, on the other hand, owns the casino. An investor looks at the fundamentals. An investor understands that time is their greatest asset. An investor knows that volatility is the price you pay for performance. If you are an investor, this week was irrelevant. In fact, it was an opportunity. It was a chance to lower your cost basis. It was a chance to add to your position while the crowd was running for the exit. If you are a gambler, this week was a disaster. You probably sold at the bottom. You probably lost sleep. You probably promised yourself you would never touch crypto or metals again. You have to decide who you want to be. The market will treat you exactly how you treat it. If you treat it like a slot machine, it will take your money. If you treat it like a vehicle for long-term wealth preservation, it will protect you. There is also the ETF trap that we need to discuss. Many people invest in gold and silver through exchange-traded funds. They think they own metal. They don't. They own shares in a trust that claims to own metal. When the market sells off, these ETFs see massive outflows. People click sell on their brokerage app, and the ETF has to liquidate metal or paper claims to meet the redemptions. This creates selling pressure that feeds on itself. But notice what happens in the physical market during these ETF outflows. The smart money, the family offices, the sovereign wealth funds, they don't buy ETFs. They buy bars. They buy allocated metal in private vaults. When the ETFs are puking metal, the smart money is often the buyer of last resort. They are taking that metal out of the financial system and putting it into the private system. They are definancializing the asset. This transfer is invisible to the average person. You don't see it on CNBC. You don't see it on the ticker, but it is happening. The gold is moving from west to east. It is moving from weak hands to strong hands. It is moving from paper to physical. The sell-off facilitates this transfer. It lowers the price so the big boys can buy more. Do not be the person providing liquidity to a billionaire. Be the person sitting on the same side of the table as them. Let's look ahead. What happens next? We are entering the month of February. The delivery drama will fade. The week longs have been flushed. The open interest has been reset. The market is lighter. It is cleaner. This is usually the setup for a rally. The organic bid will return. The organic bid is the buyer who isn't forced to buy by a contract expiration, but who chooses to buy because they see value. This buyer is slower, but they are stronger. They build a floor under the price. And as the price stabilizes, the momentum traders, the tourists, will come back. They will see the green candles and they will chase again, and the cycle will repeat. Up, flush, consolidate, up again. This is the heartbeat of a bull market. It is not a straight line. It is a series of higher highs and higher lows, punctuated by terrifying drops that test your conviction. The question you have to answer is, do you have the conviction? Do you believe in the thesis? Do you believe that the debt is unpayable? Do you believe that the supply is limited? If the answer is yes, then the price on the screen today is irrelevant. The only thing that matters is the number of ounces you own. Do not let the media gaslight you. They will tell you that the economy is strong. They will tell you that inflation is defeated. They will tell you that gold is a pet rock. They have been saying this for 50 years. And for 50 years, the dollar has lost 98% of its purchasing power, while gold has gone from $35 to over $2,000. Who was right? The media or the metal? The metal is always right. It cannot lie. It cannot be printed. It cannot be hacked. It just is. It is the ultimate truth teller in a world of financial fiction. The sell-off this week was a chapter of fiction. It was a story told by the paper market to scare you. Close the book. Look at the metal. Feel the weight of it. That is reality. As we move forward into this year, the volatility will get worse. We will see days where silver is up 10% and days where it is down 10%. The system is breaking. And a breaking system shakes violently. You have to be prepared for this. You have to steel your mind. You have to detach your emotions from your money. If you can do that, if you can stand firm when everyone else is running, you will win. You will be part of the minority that survives the transition from the fiat age to the hard asset age. This is not just about making money. It is about surviving. It is about protecting your family. It is about ensuring that your labor is not stolen by inflation. So, take a deep breath. Ignore the red candles. Ignore the headlines. Focus on the mission. The mission is accumulation. The mission is preservation. The sell-off was a test. Did you pass? If you are still holding, you passed. If you bought the dip, you passed with flying colors. The game is long. We are just in the early innings. The sell-off was just the bottom of the second inning. The establishment scored a run. Okay, but we have the rest of the game to play, and we have the better team. We have physics on our side. We have math on our side. And ultimately, we have history on our side. Do not fold. Do not waver. The best is yet to come. The spring has been compressed. The leverage has been flushed. The stage is set. Watch what happens next. Watch how the price responds when the selling pressure lifts. Watch how the physical market tightens. Watch the premiums. The truth is in the plumbing, not on the billboard. And the plumbing is telling us that the pressure is building, not releasing. The dam is holding for now, but the cracks are getting wider. Stay safe. Stay disciplined. And remember, price is what you pay, value is what you get. This week, the price went down, but the value went up. That is the definition of an opportunity. Seize it.